Hey everyone, welcome to a special in-person episode of the Julia La Roche Show. We have a special in-studio guest. We are joined today by Danielle DiMartino Booth, CEO and Chief Strategist of QI Research, and also author of Fed Up, an insider's take on why the Federal Reserve is bad for America, which, y'all, it is a must-read book. It is so great to see you. It's actually really nice to finally meet you in person.
In person, this is kind of wild. I mean, you see people across the camera over the years, and it's like this surreal experience when you're like in person. So it's good to meet you.
Likewise. And I've been in a room with you before because I have seen you interview Jeffrey Gundlach in person in the Rainbow Room several years ago.
Oh my gosh.
Awesome. And this is kind of, I feel like today is your Super Bowl. It is Thursday.
This is my Super Bowl Sunday. You know, I love, nothing gets me more energized than FOMC days. And this one was kind of a wah-wah, but I was expecting that.
Yeah. And it's a special one too, because it is on a Thursday, usually on a Wednesday. So I want to hear more of your reaction from today and, you know, what we heard from Fed Chair Powell as well.
So I think the symbolism of having a Fed meeting on a Wednesday and a Thursday really set the tone. You normally have Tuesday and Wednesday. And I think Chair Powell, you know, kind of making sure that the Fed wasn't even meeting on election day, as would normally have been the case, was his way of saying, you know, we are as independent as we've ever been as an institution. We are apolitical. And he stuck to that line and was extremely resolute and curt, I would even say. This was one of his shortest press conferences. The statement itself was extremely brief. It almost fit onto one page. And I think that this is the Fed making a statement about the fact that they will not become embroiled in politics, regardless of what the outcome of the election was. I think he would have been the same exact person had there been a different outcome to the election.
Interesting. That's a good point. Did feel quite brief. And as you put it, why do you think that is? Why do you think it was so brief?
Well, I think he did not want for any gray area to bleed its way into the Fed's data dependency. And he was asked 6 ways to Sunday. Reporters were trying to frame the same questions differently. And are you going to be going on hold? And how has the election affected monetary policymaking? And he held his line saying, you know, we can't tell you how long it takes to legislate new tax law, for example. Congress has to deliberate, and then whatever the new policy might or might not be has to work its way through the economy. We don't know what that's going to affect, whether that be growth or inflation. We have no way of knowing. So, I mean, at one point he said, we don't guess, we don't speculate, we don't assume. And he really did stick to that the whole time. And I take my hat off to him because one of the reasons that I wrote Fed Up, an insider's take on why the Federal Reserve is bad for America, let me tell you what Random House had chosen for a few of the other subtitles, which were much more incendiary. But one of the reasons that I actually took 2.5 years out of my life to write the book was because I did feel that Greenspan and Bernanke and Yellen were much more politicized Fed chairs than Chair Powell. Not to say that he's infallible, not to say that he's not made mistakes. I certainly wouldn't have taken monetary policy as far as he did after the pandemic. But since then, since he was renominated and reconfirmed by the Senate, I think Chair Powell has done an extraordinary job of trying to stay above the political fray.
Yeah. I noticed he was also asked by a reporter, and I cannot remember which outlet, if he would step down, or there'd been some chatter amongst Trump advisors. What do you think? What do you think the future holds for
I was
Powell?
on a live TV set. I just about jumped out of my skin. We were all so excited because he was asked pointedly, you know, if you're asked to step down, will you? And he said, no. And the reporter pressed him, and he looked down over his glasses, and he looked at the reporter, and he said, no. And then he moved his head on to the next reporter. And that was it. He wasn't going to elaborate. And you know what? In 1933, FDR did actually have the head of a federal agency fired, and there was no cause at the time. And posthumously, after this individual had passed away, the Supreme Court ruled that in an independent agency, this was not the Federal Reserve at the time, but it was a different independent federal agency. In any given independent federal agency, you cannot fire, as the president, the head of an independent federal agency. And we tend to forget that Jerome Hayden Powell is Jerome Hayden Powell, Esquire. Mm-hmm. And so he's a lawyer by training, and he knows the precedent, and he knows the Constitution, and he understands that he cannot be fired.
Right. So he would have to step down or retire. Mm-hmm. I suppose he can't just get pushed out.
He cannot just get pushed out, and the members of the Federal Reserve Board would have to agree for that to happen, or which they would never do that because you wouldn't want to set the precedent. That means that any president in the future could come in.
Then it would become political, I imagine.
It would become very political, but the Federal Reserve Board, the members of the Washington, D.C.-based Federal Reserve Board, not the presidents of the 12 districts, but the members of the Federal Reserve Board could say, we're going to keep Chair Powell in his position until the Supreme Court rules. And when you think about how long the Supreme Court takes to do anything, even to get a case on the docket, given that Trump will assume the office in February, there's only 15 months between February of 2025, May of 2026, when his 4-year term ends. There's really not enough time to get anything through the Supreme Court. So Powell understands the law.
Interesting. Okay, I actually didn't realize all of that because there was quite the bit
I need to get out more. I shouldn't have all those details
running
around in my head.
I love it, Danielle. Okay, one of the things, I actually really enjoyed your book. I read it back in 2022 before I first sat down with you. I have this rule of you have to read the book before you sit down with the person and do the homework.
Thank you.
Okay, so it was Fed Up, an insider's take on why the Federal Reserve is bad for America. I'm kind of sensing you might have a different take, or maybe you give it a different title, or would you add a different ending or chapter, or change anything in the book if you had to write about maybe the Fed today?
Well, if I was to write about the Fed today, I would actually be a little bit more resolute, because I think that the era that's followed the publication of Fed Up 2017, we actually saw Vice President Kamala Harris come in and be the swing voter, the 51st voter, in order to confirm an individual to the Federal Reserve Board. And, that was pretty disturbing to me, because cabinet members, traditionally speaking, are political appointees. That's expected of an administration. But when it comes to nominating individuals to the Federal Reserve Board, the original 1913 Act dictates that they should be from a variety of geographies and intellectual backgrounds, and that they be bipartisan in nature, and tradition has stated that you get the 2/3 majority in the Senate. So I think that the Federal Reserve Board has taken a more political bent since I published the book than I would prefer to see, such that you're saying to yourself, if it wasn't for Powell and maybe Christopher Waller as well, who I consider to be his kind of chief lieutenant, and who is also very apolitical in the way that he approaches the media and the way that he looks at monetary policy. If not for two individuals, we would be having a robust discussion right now about the Federal Reserve's role in climate change, about central bank digital currency, and other areas that Powell has refused to kind of cross the line and expand the Fed's mandate beyond what it should be, which would make it a much more politicized institution if you were to start saying, okay, you're members of a central bank, but we're going to have you become scientists and tackle climate change. Mm-hmm. And I do hope that the new administration, given the opportunity of openings on the Federal Reserve Board, would appoint less political individuals to any open seats that come up on the board going forward.
Stick to the original mandate.
Stick to the original mandate. And that's because you should have, as Powell said at the podium today, and every single press conference, he repeats what is on the Federal Reserve's homepage, and that is that monetary policy should be made in the public interest. That's a quote. And that means that it's made for every American and not on behalf of one administration or one's own political leanings. I don't think, President Obama is in 2012, he nominated Jay Powell and Jeremy Stein at the time. And to President Obama's credit, he was the last person who undertook the tradition of I'm trying to get a person from my political party. Jeremy Stein was a Democrat, and he was only on the board for 2 years. But in order to get that, I'll offer up to Congress somebody from the other party as well. 2 at a time, give them, a bird in the hand, and allow Congress, the Senate, to confirm one from each party so that you as a president appear to be impartial in the appointees to the Federal Reserve Board. I hope we go back to that.
Yeah. Okay. So the Fed really should be serving the interests of the American people. So are they?
Not yet. I think that I think that there have been some decent steps made towards trying to kind of rein in the Fed's role in widening the inequality gap. I think if you asked any banker on this 2-mile by 18-mile island of Manhattan if they thought Jay Powell was the bee's knees, and I think a lot of them would say no, that he really has been aggressive in trying to rein in conventional banks' relationships with the non-banks, with the shadow banks, and a lot of the risks that has introduced into the financial system, and the way that certain Fed policies have worked over the years to enrich the top 1%, to the detriment of the other 99% of Americans, which means that Fed policy has been skewed away from making policy in the public interest in favor of the favored few.
This episode is sponsored by Public.com. You've probably heard a lot about interest rates in the news lately, but even as rates start to fall, there's still time to earn some of the highest yields we've seen in years. Public.com is a powerful platform for investors who are serious about earning fixed income. Here's a quick rundown of 3 yield accounts you can access on Public. First up, the high yield cash account on Public offers a 4.35 APY with 0 fees. That means every cent is yours. Then there's the Treasury account, allowing you to lock in a guaranteed yield with the U.S. Treasuries, widely considered one of the safest investments for your portfolio. And finally, the newest addition, the Bond account, lets you lock in an impressive yield of 6% or higher. If you're looking to earn some steady income even as rates change, head to public.com/Julia. Lock in your yield while rates are still up. Speaking of the economy, I do get very different pictures. When I have when I have so many guests on this show, I get very different pictures of the economy. And I want to hear from you, your assessment of the economy, where we are today, and what are you paying most attention to?
Well, I get accused for being a perma bear on social media, and I guess maybe I'll set the record straight by saying I'm going to be the first person out of the gate when I see signs that the U.S. private sector is the chief engine of job creation. I will be barking like a happy seal because I think that that's what the U.S. economy should be when it is at its best. When GDP is running at the high numbers that we're seeing, I think it's very disturbing to see 2 years in a row of negative revisions to private sector job creation. And we have seen systematically since January of 2023, we're almost through 2024, we've seen almost 2 years in a row of negative revisions specifically to private non-farm payrolls. And that to me is not what I would consider to be a healthy economy.
Yeah. One of the things, it seems like the job creation, a lot of it's coming from government jobs.
More than 50%.
That's where it worries me, is if you get to a certain threshold of the population, maybe we're not going to go that direction, but population employed by the government, that's where it gets a little worrisome because it's a big portion of the GDP. I learned there's some Eric Bosmasian who came on the show, EPB Research, and I think he said it was I don't want to misquote him. I want to say he said 30. It was definitely north of 30% of GDP was from the government.
It is, and those are extremely high numbers. Eric does his homework. He's a really gifted young economist, and he's absolutely correct. And the reason it's as problematic as it is because the government pays more than the private sector. So you're paying more for the same level of talent. You're providing a higher level of benefits. And these benefits and this higher pay are being footed by the taxpayer, last I checked. More importantly, his mentor, my mentor, Dr. Lacey Hunt, would tell you that the more economic output that is being generated by the public sector, the more crowding out effect there's going to be in terms of the private sector. And indeed, what have we seen the current earnings season? We've seen quite a few companies, one after another, miss on their top line, miss their revenue projections, or guide down on their revenue projections. And I look at sales, I look at cash flow. It's very hard to manipulate them, very hard to fudge them. And at the same time, you'll see a stock pop. Why? Because they're announcing that even though their sales are declining, or they anticipate that they're going to be declining going forward, they're shoring up their bottom line. They're making sure that they protect their profit margins by pushing through with layoffs. Mm-hmm. And that's what we've seen in the current earnings season, in the last one, and in the one before that. In fact, we've been seeing this really since November of 2022, when Amazon came out of the gate with its first announcement of 10,000 layoffs. And it really has not stopped since then. It started as a white-collar labor market recession, and now we've certainly seen, now that we've got 1.892 million continuing job claimants, we're seeing that it is trickling down to the entire workforce.
Interesting. Okay, so I think this is such a critical part of the economy that I feel like, one, it doesn't get enough attention. Like, you have to kind of look under the hood to see a lot of these details. So walk us through, when you look under that hood, what are you seeing that's especially worrisome that might not be getting enough attention?
So at QA Research, we focus, whether it's a manufacturing survey, whether it's a manufacturing survey coming out of Germany or China, and global growth matters, and the fact that a large portion of, especially the trading nations of the world, are in recession is very relevant. You don't normally hear that Volkswagen's going to be closing 3 factories, or that Michelin or BASF they're going to be pushing through with these massive layoffs. It's very unusual to see this coming out of Europe because they have much stricter labor laws than we do. So we cannot pretend that the United States economy is on an island and not affected by what happens around it. But we follow backlogs very, very closely. And we've seen in the ISM manufacturing report several years in a row of declining backlogs, contracting backlogs. And what a backlog simply tells you is, do you have pent-up demand that you're not able to satisfy? So when you have an expanding backlog, that means that, you know what, I've got orders in my hands, whether I'm a service provider or whether I'm a manufacturer of widgets, and I've got so many orders that I can't satisfy that demand, and therefore I'm going to have to expand my workforce in order to satisfy those backlogs. But what we've seen for several years now are contracting backlogs. We had an ISM services report just a few days ago that was much stronger than what was expected. We saw the employment index itself pop up. Macro Edge, which is a new research provider that I've been following very closely, they track layoffs one at a time through publicly available announcements. We saw in the month of September that layoffs were cut in half to 50,000. That September reprieve, we saw that manifest in a bump in the October data. But lo and behold, 109,000 layoffs were announced in the month of October. So we saw a ratcheting back up of cost cutting. And we'll see that manifest going forward in higher layoffs, in sustained high continuing claims numbers. And again, that's backlogs are telling us that. They're contracting still. And what they're saying is, we may have a bump, but we don't have sustainability. You know, Ben Bernanke in his day would always talk about exit. Does the economy have exit velocity? Does the economy, can it be self-sustaining without the Fed keeping interest rates at artificially low levels or engaging in quantitative easing, growing its balance sheet? And right now, if you were to say, can the economy sustain itself? The answer is no.
Do you think we're in a recession?
I do. And I fall back not on my hunch or my instincts, but rather I look at the first quarter of 2001. I look at the first quarter of 2008. These are both quarters where historically the United States was in recession. That wasn't determined until much further after the fact. And in both of those first full quarters of recession, we didn't know that the positive GDP print initially was actually a negative for 5 quarters. The way our statisticians work, the way the Bureau of Economic Analysis works, the way the Bureau of Labor Statistics works is by way of revision. So you have to follow real-time indicators in order to say whether or not or where the U.S. economy is. And as things stand right now, we know that before revisions, that the private sector shed 28,000 jobs in the month of October for the first time since 2020. And we know that all the negative revisions to August and September came out of the private sector as well.
We also had that huge downward revision for the non-farm payrolls. Was it 812,000?
818,000. That was the benchmark revision. That was an annual revision. And so in the 12 months ended March the 31st, 2024, rather than the 2.4 million jobs originally announced and lauded on the White House lawn, we actually ended up with 1.4 million jobs created.
Yeah.
After the initial and second revisions that we get every month when we get the payrolls released, we had the benchmark on top of that. So what was 2.4 million ended up being 1.4 million. And to Chair Powell's credit, he's mentioned the fact that headline payrolls appear to be inflated when he's been at the podium.
And so it makes me wonder then, Danielle, the rate cuts. Would love your take there. We saw the 50 basis points in September, 25 basis points today. I imagine another coming up in December. Are the rate cuts the right move?
I think so. I was very much in favor of higher for longer. I think that we had to root out to force price discovery in a lot of areas of the economy. We've certainly seen it manifest in commercial real estate prices. We've seen 67%, 97% discounts on a given price for a building. And we wouldn't have that price discovery were it not for the Fed having been higher for longer than any time since Paul Volcker was in office. So I think that it was necessary and correct for Powell and the Federal Reserve Board to push through with the normalization of interest rates, to back away from growing the Fed's balance sheet. And they are really sticking to the shrinking of the Fed's balance sheet to the extent that several months ago, the New York Fed put out a report blueprinting the shrinking of the mortgage-backed securities holdings through the end of 2035. And that to me shows a much different sort of discipline in monetary policymaking. If you're saying, you know what, we hoovered up 40% of the mortgage-backed securities market. We really did mess with housing affordability. It was a policy error. And even though you're not going to come out and use those words, policy error, boy, we messed up. If you say, though, we're going to keep shrinking those mortgage-backed securities holdings through 2035, it's as much of an admission as you're going to get that the Fed wandered into an area and expanded the monetary toolbox to too great of extent. And now it's impaired mobility and the ability for people to sell their homes out from under a 2.5% or a 2.75% 30-rate fixed mortgage.
Well, you are someone who definitely knows about the housing market, and you've written some incredible papers over the years that you're very well known for. But I'm one of those millennials, and I talk about it on this channel all the time, so I'm sorry. They probably hate it. But I struggle with the housing affordability bit. And I don't know if I'm smart to wait and hope that prices come down or if I should just go ahead and do it. But what's kind of your outlook on the housing market?
And, that's what I am asked with the greatest frequency, because if I'm just on a girls' weekend in Colorado with my friends, that's the only thing that they know about me. Danielle, she knows about housing. And I do see finally cracks. It took Hurricane Beryl barreling through Texas. It took Helene. It took Hurricane Milton. And the reason I bring up hurricanes is that we've obviously had hurricanes in the past in U.S. history, but we haven't had seriously destructive hurricanes occur against a backdrop of unprecedented levels of investors in housing. And what we're seeing now is that there were so many underinsured investors that the banks are not extending the credit to them that they need in order to roll these mortgages over. So in the state of Texas, we've got housing inventory where I live back above where it was in 2019. Everything in the world of economics comes down to the law of supply and demand. And what we're finally seeing with spec home inventories, homes that home builders have built that have not been purchased, we're seeing those at the highest levels since the great financial crisis. And in addition to that, we're seeing a very rapid non-seasonal buildup in housing inventory. And so we're finally starting to see declining home prices in certain areas because the banking market has not been rationalized, because there are so many ailing banks, wounded animals, if you will. We're seeing a reticence in terms of providing the financing that a lot of these investors need. Now we're finally getting to the point where we're going to see supply overtake demand in housing. And thank heavens for the millennials, for those who've waited.
Thank goodness. How about the demographics? How about like more boomers who own homes? And if rates come down, does that open up an opportunity for them to like either downsize or move into communities? I don't know, but I do wonder.
I mean, the National Association of Realtors just came out with their annual State of the Housing Market report, and the average age of homeowners, of home buyers in the United States is now 56.
Wow.
56 years old.
The average age of
a new home buyer is 38.
Wow. Yeah, a new home. Yep. I'm 36, and so it'll be my first home.
And that's a shame. 70% of homes that were purchased in 2024, 70% were purchased by individuals without children younger than the age of 18. So we are seeing we're seeing the backlash of the Fed's foray into the mortgage-backed securities market, not once but twice. And in a lot of atrophying and over-speculation in the housing market, 17% of all home sales in 2024 have been to multi-generational households. A quarter of them, it's because people are having their parents move in with them. And we always talk about the flip side of it. We always talk about, well, I haven't left home yet, or I've got student loans and I can't afford to set up house and home, so I'm still living with my parents. We always talk about that aspect. That's about 20% of multi-generational homes that have been purchased in the last year. But we're also seeing people move their parents back in with them because it's so unaffordable to look, whether you're talking about home health care or extended care or nursing homes, areas that have been flooded by private equity now, where adult people like me, my mom is turning 78 in just a few days. Happy birthday, Mom. Wow. But I'm seeing my peers have a very hard time affording their taking care of their parents as they age. And as a result, we're seeing quite a bit of the census will tell you that since 2014, I want to say, we've seen a doubling in multi-generational homeownership in the United States because we have to have multiple generations under one roof to make it affordable.
Yeah. Wow. It's so fascinating when you think about yes. Okay. So with the rate cuts, I'm curious about what's going on in the bond market. At least, what is that about with the 10-year?
It's interesting. I try and put myself in my shoes as if I was speaking to my juniors in high school to their economics class, because if you were to talk to a bunch of 16-year-olds about the idea of stock and flow, their eyeballs would roll into the back of their head. But what we have is, I think, a failure to understand the fact that with the Trump victory, there will not be the expiration, the ending of the 2017 tax cuts. They will be extended. Now, there's a presumption that there's no political capital that's going to be spent to extend these tax cuts. That's incorrect. We have to go through a reconciliation process with our budget. And so the first order of business is going to be extending those tax cuts. But when I say stock and flow, there's not going to be any economic output at the margin just by maintaining the status quo. So you've got a stock function. If there was to be a CARES Act 2.0 on day one, just like there was a third stimulus bill that was passed on Joe Biden's day one, and that delivered the third stimulus check, $1,400 directly in cash into U.S. household bank accounts in April of 2021. If we were talking about that kind of legislation that was anticipated right out of the gate with the Trump administration, which we're not in the middle of a global pandemic, then I would say that what the bond market is doing is rational. Because then you could say all that stimulus spending ignited double-digit inflation, and we're going to see inflation reignite. Instead, we had Manheim tell us today that used car prices have continued to fall, that the areas of monetary policy that are interest rate sensitive have been very much affected by the Fed's monetary policy. So the concern in the bond market right now, I think, is a little bit fed by the mainstream financial media, that there's going to be all of this deficit spending under Trump. Don't get me wrong. Extending these tax cuts will add $5 trillion to the deficit, but it won't be at the margin. The flow of economic activity will not be affected in any way. You have to get fresh money pushed into the economy in order for there to be an inflationary impulse attached to it. And that's got to come in subsequent legislation, whether it's future tax cuts that are in addition to what already exists on the books, or whether it's money spent to House Majority Leader Steve Scalise just a few weeks ago said, first 100 days in office, we're going to extend those tax cuts. We're going to put some money towards continuing to build the wall on the border. These are not the types of legislation that are going to end up with lines around the Chanel store with people spending their stimulus checks and pushing inflation up overnight that would be problematic for the bond market. What we seem to have here, I think, is a really crowded trade and a lot of technicals going on in the bond market.
Got it. So that's why it's so great having you on. All right, let me ask you this. Elon Musk has talked about setting up the Department of Government Efficiency.
Sounds pretty deflationary to me.
There you go. I was going to ask about that because I feel like every time people say inflationary, I'm like, well, what about cutting a bunch of this excess bloat? Yeah,
look, there were, say what you will about the individual. You could say the same thing to anybody walking up and down the streets on Lexington Avenue, where we are right here. Like him or not, Elon Musk demonstrated on a particular Sunday when they said that Twitter was going to implode under its own weight because of the World Cup. It didn't happen. And it became like a contagion that swept through Silicon Valley. One CEO after another said, well, if he can do it, I can do it. They just did it quietly. And so if you're talking about using that kind of a machete approach to government excess, that is going to be deflationary. We're just 10 minutes ago, we were talking about how the least skilled workers in the United States are paid quite a bit when they work for the government. You cut that out, and that's good for the taxpayer.
Right.
But it's certainly not going to ignite bond yields.
Yeah. All right. But I do wonder, okay, so he had this playbook at Twitter, kind of made it popular in Silicon Valley, maybe quietly. Could there potentially be a playbook where maybe that is a nice, attractive thing to do? Like, let's look at our government, cut excess. Will we ever, I wonder if we'll ever truly have a candidate or a conversation of like, I want to do something about the deficit. It's so not a thing that someone could like campaign and win on, but I do wonder if at some point it could be a campaign strategy.
You have to have somebody who's basically unhinged and not part of the so-called swamp in order to come in and affect real change. And if it's going to take an Elon Musk to do it, so be it. There are areas of excess. There are areas of our economy and certain agencies that are understaffed. But you need to have the right people in the right place. Mm-hmm. And you need to have more people who run the country like you would run a business with a P&L. And I welcome that. I don't find anything wrong with that as a taxpayer. You couldn't stop anybody on the street and say, do you want to waste taxpayer money?
No.
They would all say, absolutely not.
Absolutely
Well,
not.
Are you okay with being able to collect Social Security at 63.5 instead of 62.5? Well, wait a minute. Don't you dare step on my retirement age. It's like the average American turns into the average Parisian when you actually get to talking about the nuts and bolts of entitlement spending, despite the fact that longevity, that life expectancy is longer than it once was. Yeah. We have to have serious discussions about the fact that in the United States, as of 2022, we were spending $12,200 per capita on healthcare, twice that of any other developed nation. Surely there's something wrong with this
picture. And how is our health? That's the other thing. How is our health?
Exactly.
Yeah.
So we shouldn't be spending double what other Western economies are spending on healthcare. There are obvious areas where we could come in and do some serious reform. Medicare costs 3 times what Social Security does. And that's where the runaway spending has been. It's been on the healthcare side as Americans have aged. Mm-hmm. And it's just going to keep running away unless somebody steps in and treats taxpayer money like they would treat shareholder money.
Yeah, that's such a good point. Are you getting any questions from clients about the election, or now that we have the outcome, the red wave, Trump victory, and looks like a sweep of House and Senate?
The majority of the questions, because people are alarmed about how the bond market has been behaving, is how inflationary will Trump's policies be? And my answer is stock versus flow. It remains to be seen. Now, look, I would never suggest that Republicans are tighter with the wallet of the country compared to Democrats, because we've seen that they'll spend just as much on what they want to spend on. Do I foresee post-pandemic kinds of policies coming out of a GOP-led Senate? Well, and at the risk of being extremely unpopular, Donald Trump in December of 2020 was demanding that the second stimulus check be in the amount of $2,000. And a GOP-led Senate, before it flipped blue, said, we're capping you at $600. So was that ideal? Did we need the second stimulus check? Arguably no. Did we need to extend the rental eviction moratorium? Did that really upset a lot of landlords nationwide? Yes, it did. We didn't need to extend it. We didn't need to do a lot of the things that we did with post-pandemic runaway spending, but I don't necessarily see a Trump administration being able to press forward with the progressive kind of spending I think that we would have seen coming out of a Harris administration, with Elizabeth Warren retaining her position as the head of the Senate Financial Committee. I don't see it.
Mm-hmm. All right. Last question. Mm-hmm. We
just started talking 5 minutes ago. It's impossible that this is over.
Well, I don't know. Well, maybe we'll keep you longer. I don't know what time you have to go. And I actually don't know how long we've even been going, because I'm having so much fun.
Conversation.
I want to be mindful. I would keep you forever. You really uncovered the what was going on in housing before the financial crisis. Mm-hmm. And I feel like you're someone who's really good at spotting these risks out there. So I want to ask you, what is the risk that's keeping you up at night today that's maybe not getting enough attention? And then I'll also add something that, so there's something worrisome, maybe of a risk, and then something that's making you optimistic.
I have both your answers. When the pandemic first struck, we saw an unprecedented spike in fallen angels, in the corporate debt of investment-grade companies being downgraded to junk. I mean, it was biblical. And just about 48 hours ago, there was a report that said that there's the potential in 2025 for there to be $60 billion of fallen angels, and that the lag effects of Fed policy, in that it's trickling through into a bankruptcy cycle. We saw 30 bankruptcies of companies with liabilities of $50 million or more combined in the months of September and October. You look back to 2000, on average, on any given 2 months, you get about 20 large bankruptcies. So we're running about a third higher than we were prior to higher for longer. And the Fed's raising interest rates to the extent that they have. We're running about a third higher in the bankruptcy cycle. That's manifesting slowly, but with a lag, which it should be, in the household bankruptcy cycle. So I'm very attentive to where the debt has built up to excess, which we got a sneak preview of when the pandemic hit, of companies that are rated investment grade, but that are actually junk in drag. So I am concerned about an over-leveraged corporate America. I do think about that quite a bit. And I actually don't, there's a human element that we cannot look past. You can't say, Big Lots went bankrupt and all these stores closed, and you cannot pretend like all those people did not lose their job. It's a real thing. Yeah. And it's a tragedy for those families who were affected. But by the same token, did private equity need to move in to retailers in America and restaurants in America with lower for longer, cheap money? And, you're Joe Q, you've got 2 great restaurants on each side of town. And, you're like, I'm going to open a 3rd restaurant. And you approach somebody, your other fellow small businesswoman says, I go to that firm. They're going to finance you. So you go to private equity, and what do they say? We have too much money. You just want to open 1 new location. We're not going to give you the money unless you open 10. And so we had the expansion of the retail footprint, the expansion of the restaurant footprint that was much more capacity built in than what the economy itself could support. And now we're seeing the backlash of that in this current bankruptcy cycle. So it does worry me that we need to stay higher for longer than we otherwise would to root out having the shadow banking entities of the world put so much money into the economy that you end up with diseconomies of scale and boom bust cycles like what we're seeing. I have 4 children, and I've seen, living in the right zip code in Dallas, Texas, with the right public school district, I've seen the benefit that children can get from a good public school education. And then I've seen the other 97% of Dallas and what happens when you have a bad public school education. I prefer to think of children as being in the classroom. The thought makes me happy, because when I had all 4 studying at home on different curriculums, it was interesting. And I was really happy when they went back into the classroom. But when you think of the power that artificial intelligence could unleash in rationalizing and spreading out throughout America a good public education by harnessing the value and the power of AI and applying that to education, I think that the possibilities are absolutely endless to bring the American dream back to all public school kids in America. So I know that AI right now is a bad word, and it's displacing employees, and people are being replaced by automation and by AI. But I want to think of it as the opposite of the atomic bomb that ended up being good for bad. I want to think that AI is going to end up being bad in the beginning, but good in the end for growing the American dream and being something that can be an engine of growth and begin to put the ladder back together, the rungs on the ladder for all American children going forward. And I think that if you are able to harness that one great teacher who can inspire so many children by using the power of by using the power of technology to bring that into classrooms, I think we could reignite what education can be in America.
Yeah, it's like you can all have your own personal tutor too. It's democratizing.
Absolutely.
I love that. Danielle, it's been awesome having you in studio. I want to do this again. This is amazing. So I might have to make more New York trips.
I would be happy to, Julia. You come prepared.
Okay, let folks know where they can find you on social, QI Intelligence or QI Research.
Yes,
excuse me.
We
QI
had,
Research.
We had all kinds of trademark drama. We had to become QI Research, blah, blah, blah.
Let them know about QI Research and any parting thoughts, anything that we didn't bring up in this conversation that you'd like to leave this audience to think about.
So follow me on Twitter at DiMartino Booth, please. Become a Daily Feather subscriber. We subscribe every trading, we publish every trading day of the year. DiMartinoBooth.substack.com. If you run money for a living, my QI Pro institutional research is absolutely second to none because I'm unbiased in how I deliver research. But if I was to have a parting thought, it would be this. A lot of Americans came out to vote against one person or another. In fact, a majority of Americans came out to vote against one person or another. And in doing so, came together to be a majority of U.S. voters saying, we don't need to have our politics exist on one extreme or the other of the political spectrum. I'm encouraged by the fact that the silent majority has found its voice in the current election season. And I hope that we are heard going forward. If you can get a majority of Americans to vote against one person or another in favor of a new pathway forward, then I think our democracy's got a fighting chance of surviving, as opposed to the nihilism that suggests that democracy in America is dying a slow death. I don't think that that's what this election said. I think that this election said that the silent majority can be heard and will be heard going forward.
Danielle DiMartino Booth, it's been an absolute blast and pleasure. Thank you so much for joining me today.
And thank you for having me in person.